Hello, everyone. It's time for Blocktalk. Got a couple sponsors to mention first. First off, we have Coinigy, professional tools for cryptocurrency traders. You can link all your exchanges to one place and do some trading. These guys also do a really good web show. I was on their show last Wednesday. Search it up on Coinigy on YouTube, and sign up today at coinigy.com/blocktalk. The other sponsor is Jumbucks. They're pretty cool altcoin that does lots of free tools for traders to use. This is one of their sites here. Getjumbucks.com/wisdom, and you see you get a nice 4x4 little trading tool. So yeah, we appreciate their help. And now, without further ado, hello, we got everyone here in the basement, and we got a special guest calling in, Paul. From
Hi, how's it going? Yeah. Hello, how's it going?
Oh, fantastic. Thanks so much for joining us.
Thanks for having me.
So I guess if you could explain as simply as possible, what is Bitcoin Hivemind and prediction markets?
Okay, well, so what prediction markets are, I think it's easier to describe them. They're known by an equivalent phrase, which is called event derivatives. So you can have a derivative that like pays you $1 if the stock price of Microsoft is above some value, like $43 or something per share, and you can just have a derivative of that share that just pays you $1 if something happens to trigger that payment, and otherwise it just doesn't pay you anything. And so those are normal derivatives that have always existed, but these prediction markets are event derivatives, so they'll pay you $1 if something happens in the real world. So usually they're most popular with things like elections and sports, but there are also other things like Academy Award winners or something. But the cool thing is that these things are a lot of fun to trade, and they are they have a lot of sort of financial value to people. But they also inform third parties on the likelihood, like what's actually driving events. Likelihood. So if something has a high price, this thing's going to pay $1 if Hillary Clinton is elected, and if it's trading for like 99 cents or something, you know that it's basically inevitable, or that a lot of people think it's basically inevitable that she will be elected. And whereas if it were this thing that's worth $1 if Hillary Clinton is elected, if people are buying and selling this thing for like 10 cents, you know that it's basically got something like a 10% probability of happening. So there's this really cool stuff about like informing what factors are actually likely to be connected to other factors in something that's very kind of subjective but can be measured in a very objective scientific way. So it's very neat.
So the term that I've heard described a lot is the wisdom of the crowd.
Yeah, sure.
So I guess when there's monetary incentive, people are more likely to predict the right answer across a large group of people.
Yes, the wisdom of the crowd is very wise. I mean, basically, it's a bit of a tautology, because of course, if the crowd isn't wise, then kind of like what is, right? So, but the trick is you have to be able to aggregate the opinions of the crowd in the best way. So you don't want to spend a lot of money aggregating these opinions, and you don't want to have two opinions that we have that right now in Bitcoin. You want there to be you want it to successfully aggregate, and you want everything to be incentive compatible, and you don't want to have, there's all these frictions in aggregating the information. So like I always bring up that when you have a conversation, everyone has got to basically talk to every other person to kind of like figure out where they're coming from or who they are. And this is a big like n squared kind of problem, so that it's easy for people to be friends when there's like a small group and everyone knows everyone else's name. But then as things get bigger, you get these other problems. But then things get too big, you get other problems go away, but new problems appear. And so the crowd is very wise, but you need a way to aggregate the opinion of the crowd. And that's what prediction markets do very well at large scale. They do very, very well at large scale, which is what makes them really unique. They're the only thing that I am aware of that can actually aggregate the opinion of a large group of people in an efficient, anything resembling an efficient way.
Can I ask an early question about
Absolutely.
prediction markets?
Sure.
Like, what was it about Bitcoin or cryptocurrency that enables this system? Obviously, prediction markets have been around for a while. What is it we gain from the new sort of crypto that makes it unique?
Well, the history of prediction markets is very bleak because for years and years, some of the smartest people around have, made like written pledges and written kind of like endorsements that uh, these things should be more encouraged, they should be more allowed, they shouldn't be harassed or closed down. But despite sort of the best of the best kind of tireless advocacy for this institution, it really has not gotten uh, it really hasn't gone anywhere. So there was something, the Iowa electronic markets, but that was kind of scaled back where you can only have a few choices. You're limited to like $500. And the InTrade, the most successful kind of prediction market, I guess, marketplace for predictions, that was closed down. It was constantly harassed, and then it was ultimately forced to close. So the story for me, I mean, I was interested in prediction markets long before Bitcoin existed, but I just drew a lot of parallels between things like eGold and Liberty Reserve, Liberty Dollar, and even DigiCash, PayPal, where they're sort of like you're on this track and you either kind of get neutered or you get destroyed and you can't really scale up. And every time someone scaled up to get big, to the point where they were actually changing the conversation, improving the conversation, they got kind of eliminated. So I think that I just see a really similar story, and I was really inspired by the way that the blockchain had kind of fixed this problem, and I thought that this was basically almost the same problem. And so, but there's another layer to it, which is that Bitcoin currently is kind of missing. If you want to have markets in Bitcoin, you have you have to kind of it's easy to set up bets, right, with another person, a second person, and you can even do this multi-sig bet where you have a third party be the sort of the arbiter or something if something goes wrong. But the main benefits are really lost. It's really similar to Bitcoin itself, where you had all this stuff that you could do with signatures, but if you needed a third party to prevent double spends. And with this, it's really a very similar thing where you could have all these synthetic derivatives and assets and all this betting, and you could do all this really cool stuff. But the main benefits would be lost if you had this trusted third party who had to be the oracle. And then that guy could just take the other side of every trade, and he would control 2 out of the 3 votes, and then he could just steal everyone's money. So I just thought it was tremendously similar, and I was just blown away by this sort of shadow of a problem kind of, I thought, repeated itself in Bitcoin. Prevents Bitcoin from doing things like having synthetic. I'm not a big fan of like the BitUSD, but stuff like that. If you wanted to have like BitUSD or BitOil or something, or like Bit corporations and other things like that, or any kind of bet really about anything, not just in finance, but just about you could want to bet on anything. Like a long time ago, there was the Bitcoin Savings and Trust Ponzi scheme, and someone on the forum bet that it wasn't a Ponzi scheme, which effectively there was like this arbitrage opportunity if you could bet with him and bet in the Ponzi scheme and like extract all this money. But the problem with that was that the guy who was betting that it wasn't a Ponzi scheme was sort of like didn't have enough money or wasn't serious about meeting this obligation. So there's all these kind of examples where all the stuff is there for the bet, even 2 or 3 multi-sig or something like that with this arbiter concept, but the arbiter can still steal everyone's money. I just thought it was like, it's just the same problem kind of circled around. So
you mentioned oracles briefly there, and like that's kind of, I guess, the metric for analyzing the bet, like figuring out which way the if statement goes. So like, could you, I guess, give a little more detail of like how oracles work in your system and just in general, I guess?
So yeah, so that's the major problem, right? And that's, like I'm saying, all the main benefits are lost if you need to have this trusted third-party oracle. So what I do is, it's kind of a complicated thing, but there's a white paper on this, and what happens is that I create a very strong incentive for people to vote. People have to vote on the outcome, of course, but I create a very strong incentive for them to vote near other people. And so there's kind of a lot to explain at once, but for starters, there's like a vote corporation that earns money, that's got this forced digital scarcity, and it earns money as people bet. And this money, as a function of sort of the usefulness of the network, this money kind of flows into them. And so if you want to if you want to earn this money, you can buy in to this digitally scarce token corporation. And so you've bought in, and if you're in, you can vote, and if you don't want to be in anymore, you can sell, and you can get out that way. So you kind of avoid an exit scam kind of thing there. But it's kind of hard to explain because there's a lot of things going on at once. But the econ theory behind it is that you want to establish this concept of reputation, and then have people's incentives aligned so that whenever they do anything you don't like, they pay for it. So the first way is to abstract this concept of reputation by creating this corporation with sort of shares. And then to go into another layer of it, these people vote not on each individual thing as each event happens. They don't vote one at a time. They vote for many things all at once. And then I do a big statistical trick to see, called singular value decomposition, to see whose voting is the most deviant. So, and then I punish this person the most, and then I punish everyone else kind of proportional to how close they are to that guy. So you can be punished for being, if you vote against the majority on something where everyone else was voting with the majority, you're punished more than if you vote against the majority on something where people were confused. And there's like a number of graphs and stuff that try to explain. So again, it's kind of not worth even really explaining the details, because just the kind of the crux of it, the impetus is that you want, I wanted something that mirrored real life. So in real life, how do you know what's true? If one person says X and another person says Y, well then what you start to do is you start to look at the other things that X and Y say, right? So if Y is like a gibbering madman who says all kinds of random stuff, and then you start to get the idea that there's something wrong with Y. It's Y. It's not this particular report doesn't mean anything. So whereas if X is constantly right about everything, or at least normal about everything, you would know that there's something about X that's more reliable. So after this kind of big matrix of votes is collected, and this process is done, I distribute shares in the corporation if anyone disagreed. So unless the consensus is totally unanimous, some people will lose. They will have bought shares, but they will lose them to other people who bought, say 10 shares, but they'll end up with 12, the winners. So that's again, that's to avoid the exit scam, which is the whole point, and to have this economic kind of abstraction of reputation. But there are like so many other things that are kind of like hard to explain. I mean, another thing is that when the questions are listed, there's an incentive there, which we can talk about if you want, but there's an incentive to only create questions that are very, very easy to answer. And there's even a fail-safe if you screw that up. So if you create something that's too difficult to answer, they can all coordinate on the middle answer, which is in between true and false, which is like 0.5. And so the questions don't measure anything other than the person's willingness to lie. Everyone should be able to easily just answer the questions. And so if they're not, it's not because they didn't know the answer, it's because they're up to something dishonest. And so that's another layer on top of that. And then finally, I just draw the process out. Time is a net advantage to the honest person, because you can freeze money using the blockchain and lock it in time, but over time information will become easier and easier to learn about. So like today we don't know who will be elected president, but it will become clearer to us as time goes on. And then in December of 2016 in the United States president, sorry about that, U.S. bias, but in the United States we'll know in November and December it will be very clear to us who was elected president, right? So the betting can take place now when it's very unclear, but the resolution can take place in the future when it's very, very clear and it's fresh in everyone's mind. So that's just more, there's kind of a lot of layers to it. Ultimately, the process is so slow, and the process of having multiple people vote on multiple things in a big time period, large rare votes instead of frequent small votes, the large rare vote, it actually collapses up into a like one kind of easy to measure thing because of the way singular value decomposition works, the technique I used. It's very, very easy to see once every 3 months or so which people are kind of like the honest people, because you get which people are honest and which people are like totally on a different planet. Because if you want to lie, you really want to lie about a lot of things, and so their report will look very, very different. So even if you only know about 1 or 2 of the things that are voted on, they should like all be backwards or something. So it should be very, very easy to spot on a large, infrequent scale. And so then the minors even have like options to like veto things and just force them to happen again. And so it's just very, very slow. And so I just ultimately trying to slow the process down to a degree where the attacker just wouldn't even want to bother trying to go through with this elaborate
So anyone who I guess really wants to figure out the exact like fundamentals or how the whole network functions, they can read the white paper.
Yeah, the white paper is very long, and I released it when I published the white paper a long time ago. I also released it with code that had tests to kind of help describe sort of what was going on. So there's all kinds of stuff like that, and I'm happy to answer any specific questions, but they are kind of like specific. They're not. I've tried this a lot of times, and every time I've tried to explain, it makes it kind of sound bad. But people came up to me I think at like a couple months ago, but people in Bitcoin came up to me and they said, we didn't know how to explain. It's okay. You shouldn't feel bad that you really can't explain this, because no one really knew how to explain Bitcoin, for the longest time. So I guess, I don't know if people are just trying to make me feel better or whatever, but it's kind of complicated to explain. All the pieces there are just me trying to make this resemble how it is that you learn about whether or not Hillary Clinton was elected in the most like assuming that other people are trying to lie to you. And so it is kind of very rounded off, but it does kind of sound weird when you try to explain it for the first
time. Your white paper, it's like the table of contents is almost longer than Satoshi's white paper.
Yeah, that's bad for me. But part of the problem is that Satoshi is a lot better at programming than I am, so I kind of had no choice but to stuff the thing full of the explanations and hope that it would make sense. Like, he could just do the right thing, which was like release the software, but I was like, I'm not good enough with, nowhere near good enough with C++ to sort of do that by myself. And
well, you explained the game theory pretty well with it, and we can see like the Truthcoin white paper has been circulated a lot. We got some other questions here. Dave, you have a question?
Yeah, thank you, Paul. First of all, thank you, and
my pleasure.
I'm looking forward to reading your white paper. Haven't yet, so excuse the question if it's covered by this. Okay. I love that our community is making things like this possible. Prediction markets are really a fantastic thing, and I agree with you 100%. Haven't been in the real world enough. It's true what you were saying about prediction markets being a tautology, in a sense. In some cases, they're a self-fulfilling prophecy. I mean, if the same people that are betting on an election are also the ones that are voting on it, then it becomes true. But also, just Adam Smith's invisible hand, economic incentive to put your money where your mouth is tends to make the truth rise to the top there. I think it's great if we can put this in a blockchain-based or in some kind of provably fair system. But I always try and challenge people that are building these kinds of things to not forget that the real world has evolved quite efficiently as well.
Absolutely.
And in the real world, as far as information, trusted information, reputation is the thing that tends to create things that are honest over time. Bloomberg wouldn't sell any terminals if they got the stock prices wrong, and ESPN would be soon out of business if they were reporting incorrectly on the Super Bowl and so on. Given that these organizations have advanced access to the data and have incentives to report it correctly, first of all, we trust them. But second of all, with a system such as what I imagine that you have written out in your white paper, would there not be economic incentive for these types of organizations to buy the votes and profit from the information dissemination and acting as an oracle?
Front running.
Front running, so to speak, or otherwise, just kind of establishing its and continuing their dominance in those areas. And why would there be any economic incentive for someone not so connected to buy vote coins?
Okay. So I think I'm not sure. So I might need some help answering your question because you touched on a lot of different issues, of course. So I think you mean that some people have. First, you said that some people had. The first part of your question was that some people have access to more information, and then you said why would they buy the vote? The voting is just reporting on the event after it's happening, so it's not trading.
Right.
So,
why would anyone who did not have an informational advantage choose
Trade.
to buy a void coin, or I guess flip the other way,
Okay.
Wouldn't all the vote coins already have been purchased by someone who is ahead of that second person in the information stream?
Okay, so again, I think you mean traders again, because the voters, there's no inside information. The voting happens way long after the event is over.
Right.
So you'd be betting on this. What's the stock price of whatever American Airlines group on October 5th, but you wouldn't vote on that until like December 1st or something. So it would just be some number from October 5th to December 1st, and that wouldn't change. And that's by design. By the time that people vote, they all have common knowledge, and there's plenty of time for people could have Googled that number at any time in any of the intermediate kind of time. So no one would want. There shouldn't be, although there could of course possibly be, but there really shouldn't be any significant difference in information. By the time, for anyone who owns any vote coins, they should all have the same information, hopefully. And
okay, if everyone has the same information, why is there any economic incentive for anyone to acquire a vote coin?
So you don't want, okay, I think I understand what your question is now. The vote coin, the people who own the vote coins are the employees. So you can trade. The New York Stock Exchange is run by a company that is itself listed on the U.S. Stock Exchange. I don't remember. I think it's like IE or something. But whatever it is, the vote coins are the employees. So if you have inside information, or that was part of the joke for Intrade. Intrade.com. Part of the joke was that was insider trading, because that was like a kind of like a funny. So the people with information should be trading. And they should be buying and selling shares of markets, but they should not necessarily be buying and selling vote coins at all. In fact, I would imagine that this would be a little bit like mining, where it would be something like drudge work that people would just do to get paid, and they wouldn't really care very much about the outcomes themselves at all. Does that make sense? Is that?
Well, yeah, but you don't have to do data entry if you own the data. So if you're the entity that is the first publisher or the publisher of record of a particular entity, of a particular bit of information, then you could automate the voting of this. And so again, I ask, why if you were running a racetrack, why wouldn't you be the one that's reporting on which horses are winning?
Oh, okay. Okay, I understand. So so this ultimately this will be something like what was the stock price of whatever as reported by Google Finance or something. So you're asking why doesn't Google just do it? And they might do it. I mean, the answer would be that why haven't they done it already? And they may do it. And actually, I have on the website I have like an FAQ, like a weaknesses section, like a threats weaknesses section, and one of the I think the second one that I list, which is that this project might inspire widespread use of legal prediction markets, which is a failure case that I accept. I'm totally fine with that. I would be thrilled if Google would start offering this, and they, as you say, it might not be. You wouldn't need anything other than multi-sig payment channel, right? Because someone could just open the channel with Google to bet on whatever this is, and then Google could just sign it or commit to signing it later as a third party, and then you wouldn't need anything. You would literally need nothing at all except for that. You would only need Bitcoin and one Lightning Network spoke or something. So the entire thing could be replaced by whoever's doing the data, but that would be centralized, and I don't at all, and I think most people are doing decentralized stuff kind of for no reason, but I don't think that this project falls into that category because there's a long history of trying to make these things work when they haven't been allowed to work. And you'd think, this is one thing that I thought when I first got into Bitcoin, I thought, okay, now someone will do this. As we've seen, there are many websites, Fairlay, there used to be Bets of Bitcoin. There's bitbet.com. So I thought, okay, someone will just do InTrade, and they'll just do it with Bitcoin as this rail to get in and out. You just deposit, and maybe they'll just convert it to dollars for you, or they just keep it in Bitcoin or something. But the exit scam is I think it's too insurmountable a problem for it to scale, right? Because once it scales, once it gets big, and you have like a mini Wall Street at some company where there's there's some value there that is in the millions or billions of, there's enough value on one website for one person to live comfortably for like 100 years. Once you reach that you're in this threat zone. And so I think the exit scam, but even more than that though, is that it seems that many people don't trust, they're not willing to, they have a great desire to participate in this process where they want to move their Bitcoins around and change them into assets and wagers and other things, but they don't want to go to some website and just send their Bitcoins away and get a SQL row in return or something, an HTML number. They don't want to send their Bitcoin away. So that's kind of why I don't. But you're completely right. If someone would, the entire project is really the Oracle. So if someone would be the Oracle, that would obviate the need for the project, and I'm totally okay with that, and I would prefer that to happen. But I think we can all say a similar thing about because this is stored value. This isn't really even like Silk Road or something where if it gets shut down, you can just start another one up or something. You only lost the value of whatever transaction you were planning on making. With these, the value is stored, so you could store up a lot of money, and you could be trading and earning money in there, and they can all just be wiped out, and you're back to zero or something. So it is very sort of high stakes, and you could say that you could make a similar argument, basically, that why don't we just go have Bank of America run Bank of America coin, and it could be exactly like Bitcoin, except it could just be signed by them instead of by miners, and then you'd be like,
that certainly wouldn't be my argument, but
Yeah.
I appreciate that that we want to strive for decentralization. What I concerned is that this quickly, for economic reasons, devolves into essentially a centralized solution, because if everybody's getting the information from the same place, if there's economic incentive to regurgitate the information from that same place, then that economic incentive could also be inured by the original publisher of that information.
It segues into my question. Like, they just have a head start in the automation of the Oracle process. So what are your thoughts on automating some of that Oracle concerns?
Yeah.
You reject
Yes.
the idea, or are you going to be providing sort of machine-readable bets where you're kind of encouraging people to run automatic Oracle?
It's one of the first questions that I thought about when I was designing this, and I think the conclusion that I reached was it doesn't actually harm the decentralization if you, and I call this kind of re-centralization. So if you have the decentralized layer to like recover to, it doesn't matter. You really only gain, I think, convenience and efficiency by re-centralizing kind of on top of it. So everyone might go to Google to get this thing, and that would kind of make it seem like Google was providing the sole source of the data or something. But if some censorship force told Google that you can't provide this data anymore, then people would be able to recover from that. It wouldn't destroy the thing. They would just say, okay, we can't get it from Google, but we'll just get it from anywhere else. We'll get it from Yahoo, or we'll go to like NewYorkStockExchange.com or something. And so I think it makes a really big difference. Let me see how I want to explain this. So all I wanted was I'm totally fine with the entire thing being computerized, except for the fact that it populates a big list and one human being, not one per user or something, but is just kind of manually checking it through to make sure that that they're all right. And the way that I achieve that is that I give, as you may have noticed, I give people an incentive to throw other people off. As long as you don't throw more than half the people off, you want a few of them to actually be off, because you benefit if they screw it up. So you actually have a strong incentive to like double check the results, and that's all I really want, because the way I see it, the decentralization is just a means to an end, which is surviving the censor. And so I say if you've got something that scrapes Twitter and scrapes Google and scrapes whatever and just like helps you fill in the ballot, I think that's great, and I think that could be encouraged to a very strong extent, because if something goes wrong and people can claim, well, the software is accidentally saying that it's 3 when it should say 30 or something, but we're going to leave it as 3 because we think other people are going to do that. We think other people are going to do 3. There's actually an incentive to say that, but then secretly go behind the scenes and change yours to 30. So no one will ever really know if everyone else is actually leaving it as 3 or they're changing it to 30. And so I don't see it as a very strong. It's not as dooming. I know what you're sort of saying is that this is kind of, isn't it centralized? But I think that's something that I thought about a lot. And
Well, it sounds like the centralized systems are flawed in their scalability, where once they get big enough, economically they fail, whereas this system can scale economically much better.
That's the idea, is that you really shift the blame around a lot, and you try to get the miners to sort of the same way the Bitcoin works, where it's sort of like it's a very slow, kind of expensive, gradual accumulation of this proof of work, and so it's a lot easier to kind of see what's going on, and you don't need to. It's not like the servers are raided and everything is shut down or something. It's just like very organic and kind of liquid, and so if you need to go back 10 blocks or something, you can kind of do that, and if you
The whole network
very
won't
neat,
fail. It just
Yeah.
it's compartmentalized, so only one part might go down. We have a question from Taylor actually.
Can you
Cool.
explain the payout mechanism? Like, how does the system guarantee its solvency?
do you mean for?
Like, paying out the bet, where is the money?
So there's this thing called a market scoring rule, which happens to be very convenient. Although since the invention of the Lightning Network, I'm going to add a little bit onto this, but it's basically the same thing. There's this thing called a market scoring rule where all you have to do is edit. The market exists in some state. So if it's a simple binary market, yes or no, Hillary Clinton will be elected. There will be two states, one for yes and one for no, and the market starts with some account. So you have 0 yes shares, 0 no shares, some account that has money. And if you want to edit the state, like let's say you wanted to buy 2 yes shares, you can just say, okay, what should the market account be at 0, 0, which is what it is today, and what should it be at 0, 2, and the formula will just give you what the market account should be, and then you just pay the difference, and you just update the market state. So it's just this totally atomic process that's actually very convenient because it's very, very similar to what each Bitcoin transaction looks like. They're just like one atomic thing, and so this lets everyone just you can, if you want to sell the shares, all you have to do is edit whatever it says, 40 shares to like 300 shares, and there's this much money in the market. You just say, okay, I want, instead of 300, I want it to go down to 298, and then you pay your 2 shares, and then you get the cash back. So this concept of a market scoring rule is actually immensely convenient. But the other cool thing it does is it passively issues the shares. So what I'm planning on doing is setting it up so that ultimately this can evolve into something where big players just buy up a lot of all the states. So they'd pay like $10,000 to just get 10,000 of state 1 and 10,000 of state 2. So they had just $10,000 and or whatever, 10,000 Bitcoin or whatever, what have you. It doesn't really matter, of course. But then they just have 10,000 of each, and then they would be able to open payment channels with people because they'd have 10,000. That's how you get from 0 issued to 10,000 issued without things like spam and kind of confusing.
So your odds are like 0 to 10 or something.
Yeah, and then someone could just open a channel with them, and they say, okay, I preemptively bought 20 of each or something, but then just keep editing that back and forth. And so that's kind of
the house,
yeah. And they would, those people would be like, we would create this synthetic thing like BitGold or whatever, and then these other places would be like different exchanges. So there's there's the BATS exchange, and there's IEX, and there's these different exchanges, right? So Wall Street is not just one exchange; it's many exchanges, and they all have different rules, and some of them hate each other and stuff. So these would just be that's kind of the new vision. But to answer the question, which I didn't really get around to answering, it's just this scoring rule. It just prevents. What it does is it has a bounded loss, and I force the guy who creates the market to pay all that up front. So he gets money if the market's popular. He gets a tiny cut, and but he's got to pay up front to create it. So it's an anti-spam, and it solves the bounded loss. And a lot of times it doesn't even hit the bounded loss. So the person will get a refund, but it's just a formula, and it can't lose money. It's this formula based on diffusion of. It's from physics, so it's not that it's not so each state is updated with this rule, and so there is no there's no real storage of money literally, but in an abstract sense, you have bitcoins in this sidechain system, and then you update, and you just end up with more or less cash based on the updates. So, and I don't know if I didn't make this clear. I have a huge Excel spreadsheet. I don't know if anyone even in the Bitcoin world enjoys Microsoft Excel at all to the extent that I did when I was working in consulting. But the partial derivative of this account function that relates the total outstanding shares to the amount of money, that is just that determines the prices. So as you buy more of one than the other, you are knocking the price around at the very same time. So if you bought like 1 million of, if let's say there's like 13 of state 1 outstanding and there's like 20 of state 2 outstanding, state 2 would like probably cost, it would cost more than 50 cents on the dollar. It would cost like probably 54% or something or whatever. You know, it doesn't. But if you then bought like 10 million shares of state 2, it would cost you about $10 million or 10 million units, because you get the first few slightly for cheap. You get the first few at like 60 cents or 70 cents, 80 cents, first 2 or 3, based on the trades, the money that had already been put in by people who had made trades. But then, as you had knocked the price within this one trade, you had knocked this price to the value of 1, and so you're just buying shares from yourself. So you just sink like $1 million. It's going to cost you like $1 million to buy 1 million shares, and you didn't really do anything with a lot of with about 9,900,000 of those. You just the price was at 1. And you just, what you really did is you pointlessly put a huge amount of money at risk, because on the off chance that it doesn't happen and state 1 wins, you lost all of your money for really no reason. So, and there would be and then people would be buying in, and they'd be buying in at around 0. So that would be a very interesting situation to land yourself in. But the formula is, documented, and I didn't come up with it. Other people, actual guy who has a brilliant guy who has a PhD in physics and in economics came up with it like 15 years ago, and lots of peer review, and it's not that complicated. It's very clear that it has a bounded loss, and you can check in Excel by just typing in values all day, and you'll never get it below. So the bounded loss is very small, and you can change the value as much as you want. You can make the bounded loss like 10 cents. It's directly related to the amount of liquidity you want in the market, so I would imagine that most people would set it very low and then just force other people to deal with it. But if there's a need to make the market more liquid, you can actually just pay for that. So that was a lot of luck involved with that way, how conveniently that worked out. So that is a lot more convenient.
On how much liquidity you want to offer in your own bet. If you want to run a bet for, say, your own thing, then yeah, you have to offer up some liquidity to it. Absolutely,
you're absolutely right. That's something that a lot of people often overlook, is that these markets are a little different from. They're a little different from normal markets. So there's a use case for the actual thing, like something like oil, where you need it to heat your house or move your car or something. You can just kind of sit back and wait for the market to just form, and the market will just form, and then everyone will be able to use the price to make like their capital investments, and everyone will be very happy because we'll have a price system and everything will be great. And so that's great. But if it's something like where there is no real use for the thing, I mean, oftentimes Intrade had success with the political futures because they were very entertaining, and I suspect because a lot of people wanted to kind of cheer on someone they liked, or maybe even hedge against someone they didn't like. I've always thought I had like a crazy uncle who I thought was doing that, where he hated whatever candidate, and so at least he could make a lot of money if the candidate won. I thought that was kind of what he was doing for a while. He was kind of a nut, but but basically, there's like a lot of entertainment kind of value. But if you don't have this value somewhere, there won't be really a big need to trade. It depends on all kinds of factors, right? How people's preference for like risk and stuff, and how many people have the information that you want. But yeah, you're right. A lot of times, these will need someone to front. Sometimes in one extreme, a very common extreme, some organization will want to buy. This is what I really wanted to do with Bitcoin's block size. I wanted to have just people put up a lot of money so that someone could just buy as the information they wanted, which was like the answer to some question, like should we fire the CEO, or should we change the block size, or should we elect a different president or something. So I wanted someone to just put up this money so that there'd be this big lure to like really start everything going. And then, so if you want to buy information, you can do that here. And if you don't pay enough, you run the risk of the market not being successful, which is unfortunate.
So just to follow up, that sounds like it guarantees the solvency of the bet, but how do you guarantee the payout?
I jam the final prices. So sorry, this thing on my computer is making a lot of noise. But the solvency is guaranteed. The loss is bounded. If you hit an extreme, you've lost the most you can lose. So obviously, if you don't hit an extreme, you hit somewhere in the middle, and you're sort of happier. So after the oracle, the voting procedure is done, those people have determined what has actually happened, and from there you get the final. You get like whether or not Hillary Clinton actually did win, and there I just jam the prices. I just say, okay, once the market has reached a certain time, a certain block number or whatever, it's matured, and you can now, instead of selling, you just withdraw, and you withdraw this. The prices no longer vary as people bet; they're just jammed at the correct value, and then everyone can just withdraw. Does that make sense? Like the loss is bounded, so no matter what happens, you can't lose any money, and whether or not, if Hillary Clinton is elected, all the yes shares will be redeemable for 1. And if not, all the no shares will be redeemable for 1. And so you ultimately, instead of having prices that are a function of this rule, they're instead a function of that voting process that happens on a different track. So all the market stuff is, yeah.
They're redeemable for 1 of the coins that are part of your separate blockchain, or is this
yes.
what we're talking about?
Yeah, so this is a side chain, and there's a lot to say about that. But yeah, it's just a bunch of different rules for manipulating Bitcoin. So you would end up with, and then so once you had these Bitcoin, you could theoretically withdraw them to the Bitcoin main chain, not a side chain. You could have it back in the Bitcoin world if you wanted to do that, in theory. And I don't know if you are aware, but I did something else called Drive Chain, which is about that. And there's a lot to be said about side chains and other stuff about that. It's very interesting stuff. But yeah, the idea is just that this is everything that Bitcoin is, but it just adds more message types, and obviously more, a more complicated database. And but yeah, that's basically it. Yeah.
Some people might argue that I guess the project that you originally helped out with, Augur on the Ethereum network, Ethereum is far better suited for a prediction market. Like, I guess, could you give us your experience with working with the Augur guys, kind of how that whole thing played out?
So I published this idea a while ago, and a lot of people were interested in it. And Augur was what eventually became known as Augur. They were some of those people who were interested, and there were kind of, long story short, at one point there were about 4 different teams, and I didn't think the Augur team was sort of the best team. I thought that a different team was better, and I was just working at Yale as a researcher, and I was not really working on this. It was just kind of like a spare time thing. And so Augur then did a lot of very aggressive kind of things, like they partnered with Vitalik, and they switched to Ethereum, and then they did they planned to do like a big crowdfund, and then they changed their name to Augur, and they hired like a marketing guy, and they did like a lot of posters and stuff. So yeah, they did a lot of stuff.
I'm familiar with Jeremy from their former marketing guy. He was an interesting guest on the show for sure.
Yeah, they're very interesting. Yeah, the real problem is not. So yeah, they're really nice, and they're smart guys. But there are kind of a lot of problems with. One of the big problems with Augur is that the people working there didn't totally. I mean, it's really complicated, right? Like, imagine how long it took for people to understand. I hate to force the parallelism, which is really unfair, but it took people a really long time to kind of understand Bitcoin, and there were all kinds of people, you know, many months into the creation of Bitcoin who were saying, like, who are today's experts, but at the time they didn't really know kind of what was going on, and the Augur team was just kind of learning it a little too slowly, and they really wanted to make lots of changes. You know how this is very common in Bitcoin as well. Again, where people hear about it for the first time, and then they say, okay, that would be great, but let's just change the deflationary thing, or let's just, why do we have it like we should add know your customer to this or something. So they hear about it and they kind of want to make these, people get inspired, you know, they really want to add their own thing to it, even if their own thing is like something that you thought of like 2 years ago and is not a good idea. So they were kind of like, but they kind of did all this stuff very, very quickly at the beginning of 2015 or whatever, 2014. I lose track of the years now. But they started to do this stuff very quickly, and the weird thing was that the person who was the most productive volunteer, he didn't want me to reveal, he or she, I have no idea, you know, they didn't want me to reveal their, I assume it was a he, didn't want me to reveal their identity or that they were working on the project, so they kind of did they did like all of the groundwork, C++ groundwork. They were kind of doing it secretly for a while, and Roger Veer contacted me. He heard about the project in late 2014, and we met, and he was really interested in it, and he started paying this developer, but it was sort of like put me in like a weird position where I didn't really understand. The other thing, I didn't really care but things kind of got a little out of hand with Augur, and they, I don't know, Ethereum is really new, and a lot of people I know are convinced it won't work for a variety of completely different reasons. So I find it very unlikely that Ethereum will still be with us in 2 years, but I don't know, maybe lasted this long. But, you know, a lot of things lasted a while, right? You know, Mastercoin. There's like Mastercoin. We had, Litecoin. Who would have thought that Litecoin would still be here? Litecoin, Mastercoin. What? I didn't catch.
Oh, I'm still surprised Litecoin's around, yeah.
Yeah, so we still have Litecoin. We still have, you know, Ripple. They said they were closing it down, I thought, but it's still there, right? It's still on CoinMarketCap. So, I mean, it's like weird stuff. BitShares lasted a very long time. I don't, you know, it's sort of still there. So it's like these are kind of weird projects, but none have been as big as Ethereum. But it seems so. Things really kind of, I don't know. It's hard to know what to say about that, but I don't think it's, you know, lots of people just openly laugh at Ethereum, and they stopped trying to correct the mistakes like 3 years ago, and now it's just kind of, we have the talk of Microsoft hosting Ethereum, which is like a total contradiction.
They host Ethereum after a while, like their blockchain's already like 10 gigabytes, and it's only been like 4 months.
Very, very fast, right? There's that paper. See, this is the thing. You don't really know. There's a huge chicken and egg problem where you don't know if you're any good until you really start to get the actual momentum, right? Because so you don't know if you're any good. So once you get big enough, then someone will say, okay, I'm going to write a little academic paper about Ethereum because now Ethereum's big, right? So then someone wrote that Ring of Geiges or something paper where they're like, by the way, you can just do these little computations that like multiply these matrices or something, and it will just be a huge amount of work for Ethereum to do, but it not cost you very much. And it was like, how is that? But you know, more fundamental to me is that the whole operating premise. See, this is the thing. You talk to a lot of Bitcoin experts, and it seems like many of them have like completely different objection to Ethereum. So some people will talk about the organization and how there's lots to talk about there, and other people will talk about the size of the blockchain the blockchain growth. But I mean, for me, it's just like, what is the point? Bitcoin, before Bitcoin, someone would try to prevent you from sending money in this fashion, and so you needed the money to be sent in a reliable, kind of redundant way like this, where you could recover. But with Ethereum, I'm like, who is stopping you from doing computations on your own computer? No one. So the only thing what it must be offering is the opportunity to use those computations to move money around. But again, you can kind of already do that to a large extent with this. You're going down this Oracle road again. So either you're going to do the entire Oracle thing, or you're going to just use multisig. But there's a bigger problem, which is that Ethereum can't actually work very well with oracles, because you need to, if someone has an incentive today to be dishonest, which they directly do just by being one of two counterparties to any bet, they have, if you're on the losing side of the bet, or you don't even care if you're on any side of the bet, you want to be able to control the outcome of the bet that's directly worth money to you. So the only way you can extract this long-term surplus is to have some kind of abstract reputation. So either you literally have reputation, as is in the case of someone like, Dread Pirate Roberts, Silk Road, you have some kind of abstraction, or you have some kind of, feedback or something like that. Or you have kind of like what I did, you can make like a really, really, really abstract reputation that exists like in the form of this corporation. But whatever it is, you need to have some way for people to compete on reliability in order for the Oracle path to succeed. But on Ethereum is too general. You can copy you can free ride off of someone else's reputation by just making a little thing that just watches what they do. So as a consequence, no one can compete on reputation, and it's going to be basically impossible. I mean, the security margin in this, just like the miners determine the security margin in Bitcoin, with this, it's the market capitalization of those vote coins that determines, how much vote coin do you have to buy, a lot, to shake all the outcomes. And assuming that nothing else works, none of the miner stuff which could catch that downstream. But basically, the security margin. So I'm imagining these vote coins would be worth, a good chunk of change eventually, especially eventually, once they've grown. But how can they be worth if their value is that they earn money? The vote coins are kind of a share in an abstract corporation, right? So they're earning. They're paying out shares of revenue. So how can it be worth, like, I say $1 million if someone else can just copy that? They just write a little piece of code that just copies that. That should be able to undercut this thing, and it can guarantee that it's going to perform just as well. And so, long story short, I mean, this tiny piece of code should be worth $1 million, and anyone can write this tiny piece of code. So, because it will be getting these dividend streams just the same as the main vote coin kind of set would. So it gets a little technical, but I don't think Ethereum has a use case other than it can't go down the Oracle path. So I don't know, what the use case is. I've asked people for years to tell me what they would use Ethereum for, and for a while I got back nothing. And then people would tell me they use it for Augur, which is my own project, circuitously. But people, have really never given the answer. The use cases that are featured on the Ethereum website are like not, they're not serious. These things about little locks and stuff that you are not. I mean, it's not. These are not like, this would be much better done. Everything that Ethereum does would be much better done not on Ethereum. Just like there's no reason to decentralize almost everything that is there, and in another sense, none of it is decentralized, because if law enforcement disagrees, they can just bring bolt cutters and just cut the slocket lock or something, and it's like there's no, it's very. I just don't get it personally. But you talk to a lot of different people, they'll give you a lot of weird problems, and there's a lot of burnout in the the Bitcoin wizards or whatever you want to call them, the people who know a lot about. They're just like tired of explaining this stuff. They've been explaining it since 2009 or something, so they just don't even bother talking to anyone anymore. And then so now it's kind of just like, so I don't, there's a lot to say about Ethereum. We could talk about it all night if you want.
One thing that Ethereum can't do is buy beer from our vending machine. So I don't know who here wants a beer, guys. I still got some money from our guest last time. So maybe I'll get around. All right, I'll send it off here, and yeah, you should check out our machine here, Paul.
Cool. You have to turn me around.
You can have the light go off at least to show that it's working.
Yeah, plug it in. Why not?
So we have an old vintage Pepsi machine here.
Oh, cool.
And we packed it with a Raspberry Pi to basically accept. Why is it not doing it now? To accept Bitcoin payments, and yeah, it's been working splendidly for us. I got to thank the guys in the room here for setting it up.
Pi's still.
Oh.
No, Pi's always
No,
on.
the Pi's still on.
It should go. All right.
Yeah.
Yeah. We'll see how fast blockchain that info is.
And Paul, while he's doing that, I've got a quick question for you.
Sure.
You mentioned Augur and whether or not you believe in Ethereum and Augur and so on. You have to agree that if there's any value to the world in prediction markets, and I certainly believe there is, that there will be multiple prediction markets out there. Has there been any talk about standardizing any kind of formats for interacting with them as far as oracles are concerned? It would seem that there might be some advantage to having being able to upload information to both Augur and Hivemind, and also to whatever other sites are out there, so that when an election is won, you can put your reputation on the line on all the different prediction markets. And I imagine that it might be possible to make bets between the different prediction markets in order to kind of tighten and solidify that common information thing, so that if you wanted to make a bet on Hivemind that a particular bet on Augur or a particular oracle reporting to Augur was accurate, by interlinking these various things, you could get arbitrage happening that would tend to very quickly reveal when there's a systematic problem with one of the underlying networks.
Yeah, I don't know about that. I mean, it's an interesting idea. But so first of all, as I tried to explain earlier, the security margin is the market capitalization of the vote coins. So if you copy that 10 times, all you've done is decrease security by a factor of 10, but you haven't you don't make up for it by the fact that there's 10 different systems. It's just 10 systems that are all 1/10 as secure. So I'm not sure. I don't. It's hard to say. I think there definitely will be a lot of. There will be more than one service like this. But I'm hoping that it plays out a slightly different way. And so I'm hoping that. I'm not hoping, but I kind of expect that Hivemind would be used for things that are very sensor attracting or something, kind of like these things that I think will be kind of really important. These sort of like president versus GDP, CEO versus stock price, kind of really kind of a lot that potentially embarrass a lot of people. Markets, and I think that a lot of other stuff will be done, like I think sort of like short-term sports betting will be done. There'll be like prediction market version of that, and prediction market version of like other more entertaining things. I think will eventually be kind of on a website or on like a smaller system of some kind, where it's just, it's not as serious. But I think for this, like, if you want, like, I'm imagining this could contain like some kind of synthetic Dow Jones Industrial Average in the U.S., like the U.S. stock market index, and I think like that. I'm not sure. I mean, something that serious is going to want. I think it's going to want to converge to one thing that is the thing. I think not necessarily network effect of money as with Bitcoin, but there's still other smaller network effects with, like, respect to developers and what you might call like human capital knowledge and stuff like that. Like, much easier to just learn one system. So I think there might be. It's hard to say completely, but I don't think it's. I don't think that you'd want to spread. See, the thing is, what you can already do on Hivemind is you can already create lots of different markets in different ways, and you create these different decisions, and then from there, the decisions are the bottlenecks. You can create markets that are very liquid from there, markets that use a lot of decisions. You can do lots of different things kind of within one already. So you would get a lot of differentiation even within one system. So I'm not sure, given the risk that the system would collapse, which I think is high even for one or two, because it's very experimental. But I don't necessarily think it would play out totally like that. I think it would be slightly different. I think there would be more of this kind of log distribution where there'd be like one big one and then maybe a sort of like a sub one, and then like a lot of that are just basically centralized websites that are just sort of for fun or shorter term type of thing.
What's your opinion on the, I guess, upcoming election that's going on in Bitcoin in regards to the expanding, doing segregated witness, or just going straight to bigger blocks and hard fork versus soft fork?
Well, I waited a very long time, but I did sign. I just signed like 4 days ago Greg Maxwell's scaling roadmap. So I guess I endorsed. I waited a really long time. I read it very carefully because it's become quite the issue, right? It's the talk of the town. But I guess so. I couldn't really find anything I really disagreed with seriously in his thing, so I signed it. But I think it's very clear that the debate is not really about anything other than control over Bitcoin. I don't think it's really about anything, because I don't know if if you read my blog or something, I've already proposed like 3 different ways of solving this, like in a kind of a Pareto improvement, like such that everyone can kind of get what they want, or no one is worse off, but other people can still do very well. So I've published a lot of things and tried to advocate, privately and publicly for these like win-win solutions, but they never really catch on, and I think that's because no one really wants to make everyone happy. I think I'm maybe the only one who wants, like, the only one in the conversation who wants that sometimes, and other people, I think they just want to win, and they want to kind of assert dominance or protect their turf or do some other thing that is not related to. Because I mean, I've done this like so many times for months since like May of 2015, and since it like became an issue, and no one seems to be interested in doing those things, and the sidechains, I think, are the weirdest example of that, because you could have these things as a sidechain, and everyone could get what they want, but no one wants to do that at all. So I don't know. It's really hard to say that. It's I no longer believe that the debate is really about anything other than. And it's ultimately of very low consequence, right? Because even if, other than the principle, which is of tremendous consequence. So some people say, on principle, Bitcoin can never hard fork, or it can never do anything. The rules were set, and they're not being changed. So some people say that, and so obviously in that light, it makes a huge deal. But I think ultimately, I mean, think about it, like the miners can just set the soft limit back down to 1 megabyte. They can soft fork back down. So I mean, and then if there's a hard fork, all the users, all the investors, they'll have 2 copies of each coin. So ultimately, it's not. It's really not. It's really. I think it's blown up, and I wrote about this very recently. It's it's blown up, and it has made a lot of people angry, and there's people have become very political, and there's been no recovery from that. There usually isn't in Homo sapiens, and there hasn't been here. So. That's kind of, it's very hard for me to believe the debate is actually about anything anymore than just.
Well, it's true, Paul, and that I think leads to a good question. As you intimated, it's not about the specific issue so much about people wanting to win, but maybe even more importantly, it's a fundamental question about the governance of these distributed systems and how to manage the governance in a decentralized way. So I'm going to ask you, what is your vision for Hivemind's ultimate governance? If it takes off and becomes the de facto prediction market, decentralized prediction market, who decides which versions of the code, 2.0 and 3.0, run down the road?
No, that's great.
Are you looking at building anything into the actual system to have people vote in a decentralized manner for the type of code that makes these future decisions?
Yeah, well, it's interesting. There is an idea for that. The first thing I published, was a blog post that I called the win-win block size solution, which was about using prediction markets, a very clever one, in fact, where anyone who wanted a hard fork, they could buy these coins that would give them, it would give them today's exchange rate. You could basically get a refund if it didn't hard fork, if Bitcoin didn't hard fork. You get today's price. And you could do the same thing if you didn't want the hard fork. You get a refund if it did hard fork, but you could keep your bitcoins if it did not, or whatever it was you wanted. And there was like a lot of clever math there, and it was a really neat idea. The weird thing is that would have used prediction markets to. So as a side effect, I didn't even bring up, as a side effect, you'd end up with 2 prices, and I would imagine that one of those 2 prices would be slightly higher than the current exchange rate. See, what I'm saying is you'd have basically what I call them fork futures. You could buy one type or the other type of Bitcoin, but you wouldn't need you'd be able to recover completely if you bought the right type. So if you bet on hard fork, and the hard fork didn't happen, you'd win money, and you'd win enough such that you could cash out at today's exchange rate, no matter what happened with the exchange rate in the meantime. So you have these futures on the forks, and that was like a really cool thing, because everyone could just buy and sell exactly what they wanted, and you'd, as a side effect of this, you'd get 2 prices. You get the price of Bitcoin original and the price of Bitcoin hard forked. And my 100% expectation would be that one of those would be slightly higher than today's exchange rate, and the other one would be like near 0 or something, because I would imagine that there would be some expectation on which of the 2 would survive if the fork actually happened. And so, long story short, you could within this prediction market environment, everyone could kind of get exactly what they wanted, or they could trade until they had reached that point, and that would enable prediction markets to help Bitcoin decide what to do. But it would not. I don't think you could totally use. It would be like operating on your own brain or something. I don't think you would be able to. I thought about it, but I don't think Hivemind would be able to use prediction markets on itself, because it would have no way of knowing the outcome after the hard fork, because the hard fork would, potentially, there's like you reach like an unmeasurable zone. But I thought about having like a tiny this is the original proposal, was just to pick multi-sig people. You just elect 7 people, and their job is only to report on the exchange rate and whether or not you forked, or whether or not you did other things. But they just have to report like 2 numbers basically, a 1 or a 0, and then the exchange rate in dollars or whatever. And if you did that, then you could have these markets. And I think markets are much better than you mentioned voting. I'm not a huge fan of voting, even with money, even when it's weighed by money, because there's nothing at stake for a bad vote. So it's a plutocracy. I've described in the past as so having money vote is a plutocracy, right? Rule of the wealthy, and it puts the same wealthy people in charge no matter what the decision is about. Whereas this prediction market thing, it allows people to really lever up and bet if they happen to know a lot, and it allows them to stay out of it if they don't know a lot. You could have a really rich guy who just doesn't know anything about manufacturing 2x4s, and so he doesn't invest in a 2x4 factory or something because he doesn't know anything about that. But you can have a sort of a poorer person borrow money or go to a bank or something and say, I know everything about this, and so markets, I think, are much better.
That makes sense. But when you're talking about an underlying system, the whole proof of stake concept essentially is a plutocracy, but that's arguably a good thing, because the people who have the most money at stake in a particular system have the most incentive to have that system have integrity. So if you're talking about using voting for governance, I think that's a little bit different than using for governance of how a system runs. I think that's a little bit different than using voting for oracle purposes, because there's obviously a market incentive for somebody to cheat in the case of an oracle situation, if reputational issues aside, if there's a wager that they can bet, if the cost of dissenting is smaller than the gain from that cheating, then there's an economic incentive to do that. But if you're talking about the fundamental trustworthiness of an underlying system, take Bitcoin as a simple example, there's clearly a disincentive for the people who have the largest stake in that system to undermine the trustworthiness of the system.
You're completely right. This is very similar, though, to that. The only difference is that, so if you're going to allow people to, so like I'm saying, allowing people to, capitalism is similar to a plutocracy, because the rich people have more votes that they could deploy. But what you allow is when you have this capitalist kind of prediction markets thing, you allow people to abstain, and they can, if in plutocracy you should really never abstain because you risk nothing by voting. So you could be bribed, or you could just have a huge ego, and you would want to vote. But this is really everything that you want, I think, plus the option to abstain. And as I think something you mentioned earlier about the wisdom of the crowds, and you brought it up, and I wanted to bring it up because I had thought about it for a while, and I think the real reason that prediction markets work is not so much that the truth, you mentioned that the truth rises to the top. You said that when people have their own money at stake, and that's certainly true, but what I think really happens is that there's a lot of noise, and when you ask people to put their own money up, it just filters a lot of the noise. I think the real thing is that the market ends up at the right place, and then it reaches this point where everyone is just too afraid to put their money up, right? And so I think that's is a very, very subtle difference, but I think it's more about getting people to shut up more than it really is about getting, it's sort of like it just says the conversation has ended because no one is willing to disturb this kind of equilibrium that we're in, which I think is a very interesting right. And then the person shuts up. Yeah, it makes a big deal. Yeah. I write a lot about this in I have like a whole sequence of papers, and the first one I kind of try to like describe why prediction markets are important and why I'm doing this. And I write a little bit about, I don't know if you've read, you might enjoy it. I read a little bit about how, you know, why a bet is so much better than talking, and why prediction markets are so much better than a bet, because they kind of scale and there's no inherent, the bet is very confrontational and personal, and there's this example where, you know, Mitt Romney offered this guy a 10,000, Newt Gingrich, Rick Perry a $10,000 bet, and it ended up like backfiring horribly, and because he was like perceived as an out-of-touch rich guy last election cycle, and so all this very interesting stuff happens with the bet, even though the bet is immeasurably better than the conversation, I think. But the bet can be but yeah, you're right. It's about the bets that are refused. That's the major thing that the prediction market will show that the bet does not. The bet, you never get to observe the bets that are refused as some guy, but as some guy, you can look at in-trade or election betting odds or something. You can say, okay, I know what bets have been accepted out of everyone on the planet, and therefore I also know what bets are not being accepted, and that's a big difference, I think. So that's a really interesting point.
Now, prediction markets are not immune to the same kind of sociological phenomenon that you touched on and other ones. The most obvious one, it would seem, would be people manipulating prediction markets in order to affect the real world result. Like, if it's just a question of who wins the Super Bowl, well, then that's, comes down to the players on the field. But if it's a question about who wins the election, if everyone starts looking at prediction markets in order to see who the front runners are, and if the front runners tend to gain more momentum because other people start wanting to vote for the winner, then there's an economic incentive for people to manipulate those prediction markets in order to say, hey, look, see, the wisdom of the crowd says I'm the next president.
You're 100% right that there's this, it's a very strong and very obvious psychological bias. You don't want to back a loser, because if you back a loser, and and there was evolutionary times, you could literally be killed or something, and there's this fear of backing someone who's not a winner that is overpowering. But the effect that you described is not specific to prediction markets, of course. So it's obviously, in the United States, Fox News is a pro at this. They put the guy they want, and they say, clearly he won the debate, clearly we're hearing great things about him, blah, blah, blah. And so it's not at all specific to prediction markets. The prediction markets do better as far as but yeah, you're entirely correct that people feel a strong urge, particularly when voting, to vote for someone that they assumed was going to win, which is bizarre because you think that their incentive would be to just stay home and let the person win. But they really want to, you want to join the winning guy, because we evolved our brains long before secret ballots were invented. So we have no concept of this kind of safety behind the secret ballot, assuming the ballot is actually secret, which is like, it's unclear how long that will remain the case, if it's ever been the case or anything like that. But you're right about there's a strong but there's a more interesting. So yeah, these prediction markets are usually relabeled as decision markets when they're used specifically to inform a decision, as I argue in the case of the block size markets. I say we should pick the one that has the higher market price, or that has the one that's not zero, because that's the one that the money says is the best, that the opinion has been aggregated. The consensus, to use the loaded word, is to go with this fork or something. So there's an interesting question of will people have an incentive to bet money to screw with the decision, and to what extent is that sort of type of thing likely? And the usual answer that's given is that while some people have an incentive to manipulate the outcome, everyone prefers having more money to having less money. So and another trap door, but But yeah, to flesh out that first point is that normally the market is going to settle on. So you mentioned that the elections case, right, and how the cause can become the effect. But sometimes two things are just caused at the same time, right? So sometimes one candidate really is better, and it had nothing to do with the markets or the media. And then one person, they were just more likely to win. And given that we live in a world that has media and has people with brains, why does the person with more name recognition do so much better always, right? So it's basically the same thing. There's this fear of backing the wrong person. And so sometimes prediction markets are just accurately saying that this is going to be magnified to the extent that this person will win, and there's no causality at all, and it's entirely an effect. So markets will always be an effect. Sometimes there'll be a cause, but they'll always be an effect because they'll always be measuring. They'll always, as long as this knowledge exists and the potential to make money exists, they'll always be there. To catch that thing. So no matter what, yeah.
It's like string theory. Like the act of observation will always change the result. Like
that's yeah.
Well, I mean, it's one of the ideas of string theory. Sorry if I'm paraphrasing it a bit. You have a question as well.
Yeah, just back on the implementation side. Where are you storing like the state of the market? Is this a native app, so P2P that does a discovery via DHT?
Yeah, this is a sidechain, so it's everything Bitcoin is, just with different messages, more messages to be specific.
Follow up with that. If so, is there a lot of sort of overlap with OpenBazaar and OB1, like with the front end and the messaging code?
Yeah, that's a good question. I don't think so, but I don't really know enough about how OpenBazaar is doing what they're doing. But I don't know to what extent they. So the goal for me was to change as little as, this is basic software modularity, right? I didn't want to change anything about what's now known as lib consensus, and I didn't want to change anything about Bitcoin or any of the proof of work stuff. I just wanted this to be, it's basically Namecoin's merged mind thing is what this will eventually be. Of course, it's not merged mind, so we can test it, but basically it's going to change as little as humanly possible. So that's a basic modularity concept, and I don't know enough about if OpenBazaar is going to do. I have a lot of interesting OpenBazaar. There's a lot of interesting questions about like storage for them. That, I mean, I don't know. I don't really know enough about. Sorry, I don't really know enough about how they plan on doing it. But all I can say is that I plan on making it very, very, very similar to Bitcoin, where there are headers and there are blocks, and the blocks have messages, and so the messages get passed around, and then it's just about getting the messages around, and then the software will just build a database, in LevelDB or whatever that will actually be used for everything. It just won't, you just need the blockchain to get that score of the heaviest chain, and I don't even want to touch that because it's a lot. It's above my pay grade, so to speak. It's a lot of work goes into that, and I don't even want to think about it.
Like if you want to make an offer, you have to kind of have a server up that's available.
Yeah, no, there won't be anything like that. No, yeah. So that's why I wanted to bring up the scoring rule that gentleman behind you asked about, which is that it's just an atomic state update. So as long as you can reach the network at all, you just broadcast your message and the trade goes through. And then I wanted to bring up that part about Lightning because, of course, I copied what Satoshi Nakamoto did, but it's not, it doesn't play very well to have to do that, to have everyone store everything. So try to do the same thing. I just tweaked. Lightning is very different from this, but there are a lot of disadvantages, but one or two critical advantages to mine with this issuance. And so I kind of got my little Lightning-inspired thing that I'll write about, and hopefully is, it's a lot of work, this kind of stuff. But I have a lot of advantages. Like I wouldn't need to route. These people could directly connect to mine would be much more hub and spoke. So they just connect to the hub, and then if the hub goes down, they just they just can't trade for like whatever it is, a month or whatever it is they did, whatever the custodial period was.
Quick second.
But I guess it won't be. Yeah, please.
Do spreads converge as markets get more liquid? Is it expensive to change your mind in niche kind of bets?
Oh, well, that, depends. It kind of depends. If you set the market scoring rule up the way, the default way, the prices sum to one perfectly. So they sum to 1 unit. It would be 1 Bitcoin, but it wouldn't really matter because you could rescale. And everything is just passively rescaled. In finance, only the return matters. So so that doesn't matter at all. But the prices would sum to 1, so there'd be no spread at all. But I know what you mean, because there still is thematically a spread, because when every single trade is changing the price in this system. So even though there's no actual spread, you are trading against yourself some for X%, where X is the liquidity of the market currently. So X is a function of the liquidity of the market. So if the market's very liquid, you won't move the price at all. You'll be able to buy everything, all the shares you wanted at 40 cents, and it'll still be 40 cents, and you'll get, whatever you paid divided by 0.4 shares. But if it's not liquid, you'll be moving, and you'll be drifting against the price, which is unfortunate. So I guess to answer your question, the answer to your question is still yes. That it's always the spread, or what the trader experiences as the spread is always going to be a function of liquidity, and you always want. That's what's interesting about these markets, right? Is that you want markets gain. They do better with scale. They're really remarkable, right? Almost everything else degrades with scale, but markets, they love scale. They want more people. They want everyone to be in one spot, and so they're very, very interesting, and they're very cool, and they're just So you want that would be it's a sad thing to see, like when I go on. A lot of people contacted me about when they were starting their prediction market kind of website, and it's a lot of people, BetMoose, Fairlay, these places, and there's a lot of trouble getting the critical mass, right, of users, because no one wants to be the first guy to trade. So the scoring rule and the forcing the market guy creator to put up the bounded loss cash, even if it's a very small amount, mitigates this to a great extent, but I don't know if that extent will be enough. You really want, the critical mass is very important, so that's a sad thing, that market. It's really sad to see a market that no one is trading in, because that no one will want to jump in and be the first guy. Mm-hmm. So it will just kind of, even if a lot of people are actually interested, if the engine stalls, it's like stalled out, and that's too bad.
So I think I have one final question for you, and I asked Augur the same thing, where prediction markets are technically illegal, I guess, in the United States, but their answer for what they were doing was they were being mindful of the law and working with legislators to, I guess, build a tool that could be used in a legal way, but still had a legal potential, but they weren't at fault, I guess, for any misuse of their platform. So I get. It still, I guess, goes against the idea of prediction markets are illegal in the U.S. So could you, I guess, tell us more about what your stance is on the legality of it?
Yeah, well, if they were illegal, there would be no need to decentralize, right? I could just start the website. So, but I'm just a guy who publishes papers and some software code, and Roger Ver hired me away from Yale, and in our contract it says that he has to pay for my legal fees if I get sued. So, but I don't take any. You in the United States, your liability really begins when you take money from people, which is something that I haven't done on purpose. So, but Augur did do that, and I advised them not to do that, but they did it anyway, because Vitalik and all these other people, are pro crowd sale, and that I don't know about that, So I'm very anti crowd sale. I think the crowd sale does a lot of bad things at once, and it's wrapped in this kind of free market, let people do whatever they want with their money thing, but it doesn't quite, when it comes to open source software, I think it actually does a lot of, it's the wrapping of the free market stuff is kind of, it hides a sinister core. It's not very
It's
helpful.
not illegal because you're essentially just creating a means for people.
Well, I'm not, yeah, so first of all, the platform doesn't even have any prediction markets on them at all, and you can just create, even if we were calling these, even if we were trying to label these things as markets, because again, it's just a set of rules. It's just a protocol. But even within the protocol, assuming the protocol were a thing, a user can create a decision, and then from there, a different person can create a market using the decision, and then from there, different people can trade. Right, so I wouldn't, even if I created the system, which I'm really not doing, I'm just writing about it a lot, and it's slowly being built by volunteers, which are like sort of managed by me, but not really, right? And nothing stops, but it is like other people, a lot of other people are kind of helping to do the actual development work. But the other thing is, the core of the question is that there is no, I mean, this is just a totally different thing. But to really answer the real question is that I do understand that prediction markets are not, it's really not clear that they are actually totally illegal in the United States. But obviously, yeah, there'd be a lot of places you'd have to register with and things like that. But it's not clear that this thing meets the definition of a prediction market. It's not clear that it meets the definition of anything or any market, even though that's how I try to describe it. But B, there's people have wanted to make the case for a very long time. I mean, ultimately there is, I guess it's hard to explain, but there is like a lot of people, I think, want this to happen, but they just kind of feel like they have to say they don't want it to happen. So it would be very cool to have it just sort of happen slowly and experimentally, and not, and I would want it to happen kind of very, I don't know, very, what's the word? It's sort of gradually, I guess. I just want it to sort of, yeah, organically, right. And so it just, this is an idea, and if it inspires things to happen, then that's what it did. But I really only see it as an idea at this point still. And, a lot of stuff is written down on paper, and that's free speech. And then a lot of stuff is software, but I don't know what most of the software isn't written by me, and I don't know what, it's MIT, open source.
Well, I guess they're still concerned, though, like what happened with Silk Road and Ross Ulbricht. Like, he didn't list anything on the site, but he was the one who created it and he made an example out of it.
Yeah, well, I think that would be very interesting. I mean, I think I would do better than he did in court. He's in court, right? He's in court, and 6 people did die, and it was unfortunate. It would have been a very interesting experiment if he only allowed like marijuana sales or something, right? How interesting would that have been? Because 6 people did die, and I think 5 of them were heroin, if I remember correctly, and one of them, the only one that wasn't heroin, was like a very young teenager who was like left alone by his parents, and he did a bunch of kind of like hallucinogenic drugs and like jumped off a balcony or something. And I think that would be, that's a much easier one to, you can blame the parents for that or something, right? You can go in as a defense attorney, you can just say, look, we had millions of customers, but where are the parents, And then you can kind of like, I mean, like, it's, of course, but I think, it's, I mean, you have to really imagine it in court. I mean, it's clearly he was running I obviously think the sentence was very extreme, and I'm not a very anti-drug war. I have a lot of nuanced views about it, but certainly all kinds of club drugs and marijuana and stuff should be 100% legal in my view. but as should most, almost everything, and the enforcement is a huge problem. But I think there's a huge difference between that and kind of what I'm doing. Guy from the Yale Econ department who wrote about creating a better world through information aggregate. But maybe I could be totally wrong about this. Maybe they'll be playing this video in court, and I'll be thinking, oh wow, it was a big mistake to go into that.
Well, Paul, if they do this video in court, you're going to hate this next question from me.
Okay.
But, have you had any talk about how prediction markets can and will naturally usher in assassination politics?
Yeah, I know. I wrote a giant essay about how they won't. So I'm thankful to get that question. So that's number 6 in the sequence. You can go onto the website, bitcoinhivemind.com, and it's on here somewhere. And yeah, I know people are obsessed with that question, and I actually worked through that. I'm actually happy to get the question, and I hope they play it in the hypothetical courtroom, because I did actually, before I wrote the whole thing, and I had finished it in November of 2014, I think. Oh no, I think maybe 2013. I can't even remember now. But I waited until December 3rd, I think December 3rd, 2013. I didn't publish it at all, and I spent all of November working through the assassination markets thing. And the only reason I didn't publish it earlier because I wanted to see kind of what other people had to say on the subject. I thought it would bias people's views. But the short answer is that the market will, the markets will okay, so it's kind of hard to explain, but the market is always going to be pricing the person's health accurately, so it will kind of converge to the actuarial table's likelihood of them dying. So if you put $1 million on they won't die, which would appear to give someone an incentive to put their own $1 million on no, they will die, and then shoot them. And then you click.
I'm suggesting something a little bit more sinister. What if somebody who wants to see a particular politician die makes a wager that they are going to die on a particular day via a gunshot?
Yeah.
Then if they bet against that on a market with $1 billion worth of Bitcoin, that so-and-so will not die on this day via a gunshot, then somebody who is able to actually make that gunshot has an economic incentive.
Yeah, I've thought about it for a while. So I totally understand. What you're saying. Right. So the thing is, I've thought about it, and it is possible to use Bitcoin to do stuff like this, but it is a little complicated, and I haven't written down how, and I don't plan on writing that down because I'm not interested in that. But these prediction markets are not assassination markets. So Jim Bell's essay about assassination markets has what you suggest, where the person can place a secret wager that's very specific, and then the assassin can claim it. And so these are different. So one difference. Jim Bell's assassination markets is more of a market in the sense of a supermarket where you would go and buy things at a fixed price. But prediction market has the price react to the bets as they're placed. So if you bet a lot of money on the person not dying, someone who thinks that they will die, even if I'm not planning on assassinating this person, but they say, wow, $1 million is a lot of money, someone's going to take them up on that. There's now an incentive for these totally passive, innocent third parties to just put a little bit of money on die, right? Because someone will probably take them up on this offer, right? They'll think here's $1 million. I think the person will probably die. But by doing that, you actually drain the battery. You realize you're draining the $1 million bounty. So there's this kind of negative feedback loop that is inescapable. And so the question is, does the negative feedback loop, is it strong enough to withstand the context into which it exists? But this particular setup where it's like public blockchain is very not amenable to this type of thing. And in fact, there are superior alternatives, which I write about in the essay. So if you think the politician is really incompetent, you can set the market up so that you make money if they fail to, decrease unemployment or something, and that's, you can set it up so you make money instead of having to pay $1 million. But I have
to prevent it from being used for assassination politics, it would seem, would be to have a bet cancellation feature that some committee, if you will, could decide. So, I mean, let's say that you and 7 trusted friends had
absolutely. I have that it's in the protocol and it's in the essay that at the very end I magnify everything and I say, in the protocol you can say that you can have, like I tried to mention a long time ago when this conversation began about if the question is supposed to be very easy to answer, and so if it's not easy to answer, they can select this 0.5 value of like we're all agreeing that this question is not answerable or something. Right. But there are rules. There would be publicly commonly known guidelines in advance, obviously, so that people know. It's something like 2 minutes of Googling, and then give up.
There'll probably be more effective ways to spend your money to, I guess, get someone assassinated. I would say.
And then you could just say if one of the rules is no questions about that, and then there's no, since everyone knows in advance it'll be voted 0.5, the market will never actually be able to control any money in a but there are other things, there's like different, like where it regresses to private individuals hiring other private individuals. And so I encourage you to read the whole essay and then let me know what you think. But I have never thought that. I do believe that someone will figure out how to do. I mean, I've already figured it out how to use, I think, Bitcoin to create assassination markets. But I'm not going to tell anyone about how I would do it because I'm not interested in doing that, and I don't really agree. I think prediction markets are a better version, actually. They're more effective change vehicle than assassination markets anyway, because you can describe exactly what it is you don't like, and you can profit if the politician screws it up while promoting the guy who's actually. And prediction markets are just better because they're really nice. It's hard to understate. A lot of people have no idea what they are or how they can be used, but what really bothers people often is how helpless and confused that they feel. And so when people feel like there's a process that actually works, or there's some phenomena that actually reliably gives them information, I think they would be happier about that. So I think there's lots to say about that. And in fact, that essay is something like 26 pages long, all in itself, and it's like all text, so there's no pictures. So, but yeah, I used to get that question all the time, and I used to kind of sit back and say, I don't know, what do you think about that? And I don't know if, but yeah, there's lots to say about that, but I don't think it's likely at all. I would be a little disappointed, but certainly that would be a case for censorship resistance, though. You would need, certainly would not allow those things to exist in any organizational, any centralized business in the United States or elsewhere. But yeah, that's a neat thing to talk about in bars.
Any final questions, I guess, that anyone watching the show, I guess, has that they can go to bitcoinhivemind.com and get in contact with you to explore this topic a lot further. We're coming up here on 2 hours. Like, Pico, I know you had a question. Is it really small? Okay. We like to end the show with our pseudo prediction market that we do, where we predict the price of Bitcoin. And I got to share this one from last week because it's actually pretty phenomenal. The price was crashing while we were doing it, and we predicted a week in advance what the price of Bitcoin will be. And I think Jeremy actually got this one. He guessed the opening candle price perfectly. Yuri, I'm sorry, it went up a little bit and then back down, but whatever you're doing on the Taurus exchange, it wasn't affecting it. So. So we'll go around the room here, and we'll get everyone's, I guess, prediction and end the show with what they think the price will be. So we'll start off with our guest of honor here, Paul. What do you think the price of Bitcoin is going to be next Thursday at this time?
Next Thursday? What is it right now? I got it on my phone, man. It's 386. What is it? I have 386.75. I don't know if that is So, okay. Well, I mean, the logical thing would be to just say that it will only go up a little bit. So I'll just say it'll be 390 in 1 week. I mean, so I'll be a really boring guess, and I'll just say that they're all net present value, zero projects, and it's efficient markets.
You can see by the grouping of the lines, a lot of people guessed the same price would be a week later, and yeah, sure enough, we rebounded. So
yeah.
Wisdom of the crowd at work there.
Yeah.
Cam, what do you think?
391.
Ooh, price is right in it.
Yeah, price is right.
You coward.
Yuri.
95.
Okay, I'm gonna say. I'm so conflicted. I think by next week we'll probably be down to 350. I'm gonna be a little bearish. Sorry, I forget your name.
Dylan.
Dylan. Okay. Dylan.
377.
377.
I'll be the ball. I'll go 415.
415.
You're planning on buying a whole bunch, aren't you?
Sorry, your name again?
Peter.
All right. And David.
I was hoping to go last. I was going to take one extreme or another. He said 415. I'd go 416, and then get everything high. Or you said 350. I'd go 349 and get everything low. Watch too much pricing.
I actually have a funny joke about that after you're done with the.
Okay, but why don't I say 416? I'll be bullish.
16.
Yeah.
Okay, Kiko.
400 round numbers, magnets.
All right. And Darren.
I'm going to go 405.
405. And Taylor.
420.
Hell yeah.
It's also been a magnet in the recent months.
Yeah, 420 is the key level.
For a while.
I shouldn't have told you my strategy then.
No, but that you joke about that strategy, but I know when I was working at Yale, I was working for a very important person who knew lots of other important people who are in the Society of Forecasters or something, and there was a guy who was doing very well, and the guy I was working for, Dr. Nordhaus, who's like a super smart, super important guy. He's like asking him, cause he wasn't a forecaster himself or something, but he asked this guy, oh, what's the secret? And he's just like, I don't know. He's like, I try to be on the high edge or the low edge because there'll probably be a shock, and then and if it's in my direction, I win or something. So that's you joke about that, but the actual this is not like any serious forecasting, but there was like an informal thing, just like this, and the guy who was winning was doing exactly what you just joked about. So, there's a lot of merit to it, obviously, and it highlights perfectly forecasting when there's no skin in the game, right? There's no, yeah.
Exactly. If I had to bet on it, I would have given a different answer.
Sean actually did the same thing.
Yeah.
Well, thank you so much for coming, Paul. I'm sure maybe we can have you on sometime in the future. Maybe when you got something launched for us to play around with,
yeah, sure.
Get a demo.
Yeah, we're almost. We have a nice kind of test net that's sort of bubbling up. So when it's maybe like in a few days, if it'll be. So maybe I'll send you out. I'll ping you back, and then we'll kind of see kind of where it's going, and maybe you can tweet it out, and then maybe a couple months later.
Yeah,
we can have a more interesting conversation. Yeah.
All right, fantastic.
All right, cool.
From us here at Blocktalk, we thank you so much for watching, our one viewer, and anyone who's watching after the fact. So we'll see you in the next 1,000 blocks.